there's this health insurance company that's trying to completely reinvent how we deal with healthcare. They're growing fast, the stock's been on a tear lately, but insiders have been selling a lot. Let me walk you through what I found because this story's got some interesting twists. The company is Oscar Health, ticker symbol OSCR. They're trading at around $22 right now. And I know what you're thinking. Health insurance sounds boring, right? But stay with me because this isn't your typical insurance company. First things first, what did they actually do? Oscar Health is basically the tech startup version of health insurance. Imagine if someone looked at traditional insurance companies with their terrible websites, confusing phone trees, and outdated systems and said, we can do way better. That's Oscar. They built everything from scratch using modern technology. They've got an app that actually makes sense, telemedicine built right in, and they use data to personalize your experience. It's like comparing a Tesla to a 1995 Honda Civic. Pretty cool, right? Here's the important part to understand right off the bat. This is a small cap company. Their market cap is about $5 billion. That might sound huge, but in the health insurance world, that's tiny. Companies like United Health are worth over $500 billion. Oscar's the David fighting Goliath. And like any small growth company, they're not profitable yet. They're losing money while they build. Let me show you the numbers. Last quarter, they pulled in $3.07 billion in revenue. That's not bad at all for a company that only started in 2012. But their earnings per share? Negative 0.55. They're burning through cash. Now, before you close this tab, remember, this is normal for growth companies. Amazon lost money for years. Netflix lost money for years. When you're building something big, you spend first and profit later. The question is, will Oscar get there? Let's look at the growth. Their revenue has been climbing steadily. We're talking billions now compared to where they were just a few years ago. The trend is clearly up and to the right, which is exactly what you want to see. But here's where it gets tricky. If you look at the stock chart over the past few years, it's been wild. Crazy highs in early 2021, like most growth stocks did during the pandemic boom. Then it absolutely crashed in 2022 when interest rates went up and everyone ran away from unprofitable companies. But this year, the stocks nearly doubled. It went from around $12 earlier in 2025 to over 22 now. You see where this is going. So what's driving that rally? Is it because the company's about to turn profitable? Is it because insiders are confident? Well, not exactly. Let me show you the insider activity. In September 2025, the president of technology sold almost 400,000 shares for over $7 million. That's a big sale. Then you've got multiple other insiders with proposed sales lined up. Officers, former officers, directors. We're talking millions of dollars worth of stock that insiders are either selling or planning to sell. Now, I want to be fair here. Insider selling doesn't always mean the company is in trouble. Sometimes executives sell for personal reasons. They need to buy a house, diversify their portfolio, pay taxes, whatever. It happens. But when you see a pattern of selling and nobody buying, that's worth paying attention to. Think of it like this. Imagine you own a pizza shop. Business is growing, more customers every week, but the co-owners who work there every day keep selling their shares to outside investors. Wouldn't that make you wonder if they really believed this pizza shop was about to explode? Wouldn't they want to hold on to their shares? That's the vibe I'm getting here. Now let's talk about valuation for a second. Their price to sales ratio is just 0.52. That means investors are paying about 50 cents for every dollar the company brings in. On paper, that looks cheap, finding a dollar bill on the ground and only having to pay 50 cents for it. But here's the catch. That only matters if the company can actually make a profit from those sales. It's kind of like saying a restaurant is packed every night, but they're still losing money because the menu is priced too low. Oscar is still not profitable. They're burning cash. And until they can flip that switch and start making consistent earnings, that low price to sales ratio might just be the market saying, yeah, growth looks good, but show us the profits first. Let's talk about the actual business for a minute. Oscar operates in a massive market. U.S. healthcare is a multi-trillion-dollar industry. Even a tiny slice of that pie is worth billions of dollars. And Oscar is going after individual and small business health plans, an area that's been underserved and ripe for disruption. They're expanding too, adding more states, more members, more revenue every year. The growth is real. But here's the problem. Health insurance is a brutal business. The margins are thin. You're basically collecting premiums and hoping your members don't get too sick. If medical costs spike, you lose money. And you're competing with giants with way more resources, way more data, and way more leverage with hospitals and doctors. Oscar is trying to use technology to change the game, but it's not easy. You see what I mean? Now, let's look at the options market for a second. The put-call ratio shows more calls than puts, which means traders are generally bullish. People are betting the stock goes up. And to be fair, it has been going up. But here's my question. If insiders are selling, why are retail traders buying calls? Sometimes there's a disconnect. Sometimes the smart money knows something the crowd doesn't. Imagine Oscar is like a food truck startup. They've got a great concept, the food's good, people like it. They're opening more locations, revenue is growing, but they're spending way more than they're making on marketing, equipment, staff, everything. The founders, they're cashing out some of their shares. Not all of them, but enough to make you wonder, do they think this is as good as it gets, or are they just taking some chips off the table while the stock is hot? That's the situation here. Now, I don't want to sound all doom and gloom, because there is a bullish case for Oscar. If they can keep growing revenue, improve their margins, get to profitability, and prove their tech-first model actually works at scale, this stock could absolutely explode. We're talking potential multi-bagger returns if everything goes right. Small-cap growth stocks are all about potential. You're not investing in what the company is today. You're investing in what it could become. But the risks are real. They're burning cash, insiders are selling, the health insurance business is tough, and if they can't get to profitability soon, they might need to raise more capital, which would dilute everyone's shares. So, what's the takeaway here? Oscar Health is a high-risk, high-reward stock. It's a small-cap growth company trying to disrupt a massive industry. Revenue's growing fast, the stock's been on a run, but insiders are heading for the exits. If you believe healthcare needs to be modernized, that people are desperate for better insurance options, and that Oscar's approach is the future, there's potential here, but you need to go in with your eyes open. This is not a safe bet. This is a speculative growth play. You could make a lot of money, or you could lose a lot of money. Me? I think it's worth watching, but I'd want to see insider buying, not selling, before I jumped in. I'd want to see a clear path to profitability. I'd want to see proof that the model works at scale. Right now, it's just too early to tell. Oscar is an interesting company with big potential, but the insider selling is a red flag I can't ignore. What do you think? Are you bullish on Oscar, or are you staying on the sidelines? Let me know in the comments. I hope this video helps you on your quest for profits. Catch you in the next one.